This week's Bullion Market Update starts with some highlights from a current billionaire bond king, Scott Menard. This audio was recorded this past Monday, October 19, 2020. It's from a discussion entitled The Long Road to Recovery, and it's courtesy of Guggenheim Partners.
The current proposals on the table, I don't even want to say they're doing much better. I'm not sure they're doing any better than the last round. Eventually it will get exhausted, and we'll be right back at with Congress and have our hat out. Now, what's interesting is that, if we do get a Democratic sweep, this is going to give the populists on the liberal side a lot of power, and things like the new green or the Green New Deal and modern monetary theory, I think are going to come to dominate the discussion, and I think we're fundamentally, whether it happens in this election or the next election, in the process of reshaping the entire economic system of the United States.
Wow. I mean, listen, it's a big statement, but I've had conversations with many people in D.C., and the thinking, to your point, kind of goes, if we get the Democratic sweep, and it's not a political statement one way or the other, that it's kind of, because we've got the pandemic, by the way, which you might have heard about, it opens the door to get a lot of things done under the guise of, well, we have to do this. And I bring that up because if you get the sweep, is there a chance for maybe a $4, $5, or $6 trillion package, Scott, on top of this latest one? Because in the pandemic, now you can say, well, we have a pandemic, so we're going to also do the Green New Deal. We're going to do Medicare for all. We're going to pay off all the student loan debts. And whether you agree with that or not politically, the point is, could we see another 4 to 6 trillion of spending? Because let's be honest, okay? Right now, the concept of money has very little meaning.
Yeah, I mean, it's certainly not the way I was trained at the University of Chicago to think about money. But to your point, Brian, if let's say there's a sweep, we're going to get at least a $3 trillion stimulus package. And especially if, what I see happening in the economy, that it's stalling out right now, it's not going to be enough. And, we'll be back at Congress looking for more. So, your question, the idea is, can you have $4 to $7 trillion of stimulus? Yeah. And I mean, let's just settle on $5 trillion. If that's not disturbing enough for, fiscally responsible people, add to that there's a structural deficit today of in the neighborhood of $2 trillion. So we could actually find in 2021 that we run a $7 trillion deficit, which compared to the size of the economy is roughly a third. We've never in our history had anything like that.
The stuff you're talking about, $3, $4, $5, $6 trillion in additional spending is just going to prime the pump for the equity markets. And, you're the global CIO, you can buy equities. Would you agree with that perspective?
Yeah, I do. I think the thing I always do at this point, though, Brian, is, I've come out on your network and made, statements that, expressing caution over stocks, even though, they are, I think, going to have a lot of running room to the upside. They're the high beta trade. And if you want to do the high beta trade, there are bets that I think are a lot more certain, such as precious metals and corporate credit, which you can lever and get more certain returns than what is likely in the stock market.
Welcome to this week's SD Bullion Market Update. I'm your curator, James Anderson, on behalf of SDBullion.com. Before we continue, do me a quick favor, scroll down, do a quick smash on that like button as we collectively look forward to the way this decade may unfold for precious metal investors to come. Last week, if you recall, we touched on the coming further growth of the Federal Reserve's balance sheet. You might recall this chart and how the Federal Reserve's ballooning balance sheet is tightly correlated with a rising gold price. We'll have a listen to this just over 2-minute discussion published last week on October 15, 2020, between financial experts Grant Willians, Bill Fleckenstein and Felix Zulauf, from episode 9 of the In-Game podcast. And I will return following their comments to put them into perspective on this chart.
When we talk about the bond market getting out of control, and we talk about some of the steps that the authorities are going to have to take, do you see them mandating treasury holdings? Do you see them mandating that pension funds need to up their treasury holdings? Because something here doesn't work. You cannot have higher rates with the amount of debt we have, because the whole system will break. And at the same time, it's the longer this goes on, the more debt that has to be issued. The central banks are going to struggle mightily to absorb all that. So they have to find someone to take that debt on. So do you think that we're going to get into that fairly soon, where governments start to say, okay, there are levels you need to hold in your portfolios?
No, I think in the first step, it's all central banks that take up the paper. I think in the next step, later on, you will get those mandates. Yes. And that's part then of the new game, as we discussed before. Yes.
When you say, I mean, this is all tied together, but when you describe the situation that could argue for sort of structurally more unemployment, and given the Federal Reserve's new jihad for targeting unemployment very aggressively, and they're more willing to let inflation run hot, it seems to me that they are going to be required to be even more activist potentially, especially when you layer in the fact that the government's going to issue more debt because it's going to be bigger from a fiscal side. So it sounds to me like these central banks are going to be actively not only printing money and buying bonds to finance the deficits, but they might have to even up their QE to try to get the employment down if the bond market rates start to try to back up a little bit. Does that seem logical to you?
Sure. By the end of this decade, I would say that the Fed's balance sheet is probably at 40 or 50 trillion or something like that.
Oh my God.
It's basically, we
become the BOJ.
I think, Grant, we talked about that at another instance. And I said, at the end of the day, the debt of the system will end up on the balance sheet of the central banks. And that will only be prevented if you change the rules such that you force pension funds and insurance companies, whatever, to take it up. So, that's the way we are going. Somebody has to pay for it. And the easiest way to pay for it, the pension funds can probably not pay for all that, right, because they don't have that much money and they are not that liquid. But the central bank can create the money.
These recent comments by billion-dollar asset manager Felix Zulauf essentially 6 to 7 multiple the current Federal Reserve's balance sheet, which is at just over a 7 trillion fiat Fed note level currently. If Felix's prognostication proves accurate, and if this current correlation holds up, that is perhaps how we could find a gold price range above 5 figures, or over 10,000 fiat Federal Reserve notes per troy ounce by the close of this 2020s decade. This all may sound ridiculous, but if we study the current case of Japan, who now has nearly 3 times their debt to GDP level, perhaps there is way more room for the Fed's balance sheet to expand in the coming years. Let's hear just a bit more about turning Japanese from billionaire bond king Scott Menard, who we started this week's update with. Let's hear from him about where he thinks the end game of all this perhaps may lead.
And I wrote a piece a while back, I don't know if you read it, but it talked about the roadmap for the Fed. And the first thing on the list of options was they would do forward guidance. And then they would go to yield curve caps. And then after that, they would end up being forced to buy stocks, which is what a lot of central banks are doing now. And if all else fails at the end, they'll move to historically the great conservative traditional reserve, which is gold.
It's timely that Santiago Capital recently updated their G8 fiat currency M0, M1, M2 pile versus their official gold bullion reserves data columns, especially given the recent viral crisis that created a lot of currency this year in 2020. The final third column on this data chart gives a current gold price in fiat Federal Reserve note terms in order to back the local fiat currency supply 100% by the respective nation's official gold reserves. The only suggestion I would add here is that we would do this calculation by 40% as opposed to 100%, given historic precedent of how major structural changes in monetary regimes tend to hit that level of 40% more often historically, especially in U.S. financial history. Have a look at this chart for that point illustration. Another interesting point on this current gold versus local fiat M0 pile is that the Russian Federation has pretty much gotten its official gold bullion reserve position established now. And given recent reports, it appears that gold bullion is starting to flow to the Russian banks for private client investments in gold bullion. Already, the Russian Federation only requires a fiat Federal Reserve note price of 2,097 per troy ounce of gold for their M0 fiat ruble pile to be theoretically 100% backed by official Russian gold reserves now. If somehow you miss this story about Russia going long gold bullion since the year 2006, you can find it in our SD Bullion blog via internet search or within this week's show notes below. Turning to silver news for this past week, Citibank calls for $40 an ounce silver price within 12 months as robust investment demand continues and industrial demand rebounds. I pose that the harder question for Citibank is to answer at what price silver spot will pass their stock price, perhaps also occurring within the next 12 months of time. But I digress. Forbes magazine went further with coverage from this week's Citi analyst note stating Citi, which is a well-connected resources research team, has put its neck on the silver block in an advisory note with a tip that the price of the metal will rise to $40 an ounce over the next 12 months. Silver is currently trading around 24.80 an ounce on the London Bullion Market, having already risen by 38% from $18 an ounce since the start of the year. Citi's case for silver is based on growing demand from investors who see silver as a cheap entry point into the world of precious metals dominated by gold, with a bonus of strong industrial demand. But the bank doesn't stop at 60% silver rally. It also argues that there's a technical case for silver doubling $50 an ounce and potentially rising fourfold to $100 an ounce. The bank said its foreign exchange FX technical team is very bullish on silver, with $50 an ounce a very realistic target and $100 an ounce possible. So, in summation, the coming year and decade remain squarely bullish for precious metal beta bets. We suggest moving quickly and establishing your positions. That's all for this week. Thank you for coming by, and as always, take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.